Investing for Beginners, Lesson 1, Investing Terminology. This video goes over the various investing options that you have when you decide to invest in the stock market. But this course does not cover these topics in detail or even after this video, because some are more advanced options and some deal with investing in a less hands-on approach. And that's not what we are about here at CFE Finances. We will give you a comprehensive overview of all these options so that you understand why, as a beginner, you should stay away from them, but why eventually they may be a viable option. A margin account allows you to borrow money from a brokerage account so that you can buy stock, make a decent amount of money, and then pay back the margin account with interest. These are dangerous because you have to make money or else you have to sell right away to pay off the margin, or else you will owe your brokerage account money. A mutual fund is a fund comprised of many different stocks in order to try to protect your investments while making a return on your money. We don't recommend mutual funds because you have no control of the stocks picked and how the fund is managed. And the idea of our company is to teach you how to do it yourself. ETF stands for Exchange Traded Funds. At this point in the course, we have not gone over indices, but an ETF is an assortment of stocks within an index. Short selling is when you purchase stocks at a certain price from your brokerage account and then sell them right away in the hope that the price will drop considerably so you can buy the shares back at a much lower price. This is a dangerous approach and actually hurts the stock market as a whole because it promotes stock price drops. Bonds could potentially be something for anyone to get into, but it really is a subject all on its own, so we don't cover it. But bonds are considered safe investments that are good to have in your portfolio because you can make consistent money at a decent interest rate. Options are a very risky strategy that allow you to buy the right to 100 shares at a much lower price in the hopes the stock will increase within a certain time period, usually 3 months. Options are more like a bet. You bet that a stock is going to go up or down within a certain period of time, and if you are right, you make a good amount of money, but if you are wrong, you lose all the money that you spent on the bet. This slide is designed to explain some terms that don't fit into a specific part of the course, but we feel you should know and be aware of in case you read something or watch something on television and it mentions these terms. A bear market is when stocks are not going up in value and tend to stay flat or drop in value. It is a good time to buy in a bear market because you can save up money and buy a large amount of shares at the same price. Once stocks start to rise again, the market goes into a bull market. A bull market is what all stock investors love, especially if you are already invested in the stock market. Stocks go up more than 20% in a bull market. Volatility is the amount of change in a stock's price in either direction. Volatility is normal in a stock market because stocks are always being bought and sold. Stock splits don't happen too often, but they are great if you own a stock that has a stock split. This means that the stock price is split in half, but you are given double the amount of shares. You don't gain or lose any money, but now that the price is lower, you and others can buy more stocks and drive the price up again, so you continue to make money. Reverse stock splits don't occur very often either, and hopefully they won't happen to a stock you own. A reverse stock split occurs when the stock is having trouble and the company wants the price to be a lot higher than it is. So the stock price is doubled and you lose at least half of your shares. If any more words come up that you are unfamiliar with or don't understand, please use the glossary below to search and hopefully find the definition to the phrase you are looking for. Thank you for participating in this video. Please continue to the next one.